Well, Carl, Roku's Anthony Wood telling me that the company's growth, 1.1 million users added in the first quarter, was moderated by the end of government stimulus payments, while the company's business of selling its software on TVs was particularly hurt by supply chain issues, which aren't going away anytime soon.
But the supply chain issues it costs more to ship products. It's harder to get parts. That's causing the prices of TVs to go up. That's reducing the number of TVs that are sold overall by the industry.
Looking ahead to the second half of the year, the company expects growth to reaccelerate in part because of easier comps with last year and in part because Roku expects more ad-supported streaming options to help shift more ad dollars from traditional pay TV into streaming. Wood telling me that Disney's ad-supported option and Netflix, the fact that it's working on one, are a good thing for Roku's platform.
Advertising generally is a very important part of the streaming ecosystem. It lowers costs, it increases engagement, and it increases the number of people that are streaming. And so that's good for us as a platform because it increases the amount of viewing.
I asked Wood if he was concerned that the new joint venture between Comcast, which is CNBC's parent, of course, and Charter, which was announced earlier this week, they're planning to offer a new streaming platform and devices similar to Roku. I asked him if he's worried it'll take market share.
We've been competing with Google, we've been competing with Amazon in multiple markets around the world. And we're the number one, and we've been competing successfully, and we've been winning. Our competitors are big companies. They're very successful companies, but they have other businesses that are more important to them than streaming. And so, they're not as focused on streaming as we are.
Another potential threat that's been raised by analysts, the merger of Warner Brothers and Discovery, giving the combined company more negotiating leverage with the platform. But Wood told me that mergers will create streamers that can succeed on his platform.
Merging is helping to build more competitive streaming services. And streaming services are not just competing in the U.S. now, they're competing on a global basis. They have to have a lot of scale to compete, to be a platform.
Now, Roku shares are up over 8% today, but they are still down 72% in the past 12 months. Analyst Craig Moffett this morning upgrading Roku from sell to neutral, saying with the stock trading below $100, now the company's forward estimates reflect what he sees as a more appropriate view of what's going to happen later this year. But take a look at what a roller coaster for that stock. Guys?
Yeah, Julia, it's been a lot of pain. I can understand why some analysts will be giving it a second look. I guess, you combine the Comcast Charter JV, what we heard from Netflix, certainly what we've heard from Roku. It all adds up to, wouldn't you argue, an overall maturation of the business, right? And even that bit about now superseding legacy TV, that we're really in a moment.
Yes, really in a moment of maturation. I mean, if you think about it, this shift from, this proliferation of sort of endless streaming video on demand services to this idea that if you really want to compete, you also have to have some lower priced ad supported options. I mean, we have to remember that Roku does have its free ad supported Roku channel. And the question there is, are they going to have to be holding on to that ad market share? Is there enough ad market share to go around as more ad dollars shift over from TV, or are they going to be competing more with the likes of a Netflix? And it was something he would not address directly. I tried to get him to go there, but of course there are going to be a couple of years before Netflix launches its ad-supported version, though Disney Plus has its coming later this year.